Well, as you guys know, one of the investors I follow very closely is Mohnish Pabrai, and about a week ago now, he put out a new Q&A video on his channel with the Kolkata Value Hunters Club. So I watched the whole thing and have pulled out some very interesting clips which I think give us great insight as to how we should be investing at this moment in time and how Mohnish is thinking about the stocks he holds in his portfolio. So let's have a listen to all the best bits right after this. This video is brought to you by Sharesight. Sick of tracking your performance manually? Track capital gains, dividends, and currency fluctuations easily, and when it comes to tax time, have everything you need ready to go with just a click of a button. Try Sharesight for free or use the referral link in the description to get 4 months free when you sign up to an annual plan. So the first question Mohnish was asked was essentially, should you be waiting for some sort of stock market correction before investing? Or should we still be looking to invest in specific sectors or businesses right now?
Yeah, so I think those are good questions. Well, I think that COVID can give you an opportunity. That's a possibility because it creates uncertainty. I'm always a bottoms-up investor. So I always look at a specific business and I look at the kind of nuances around that business. I've never taken an approach saying I need to have exposure to a certain sector or anything like that, or even a certain country or anything like that. So in my opinion, I think the first question to ask when you look at a business is it within your circle of competence? Is it something you understand well? And then the second is, I think the questions after that become easier because there are some businesses which may not get impacted much by COVID. Just the nature of the business, they just may not keep. Let's say, for example, I look at a business like Jio, for example, right? What impact is COVID going to have on Jio? I don't think it makes much difference. People need to communicate. They have bigger degree need to communicate when they can't see each other. So if anything, a business like Jio does better while COVID is happening. On the other hand, if there is some, let's say, private hospital, the government may put all kinds of mandates on them, right, during COVID. And it may or may not even be able to make money. So it becomes a lot murkier whether what would happen in the next year or two in other businesses. So I think that the question would be, can you see clarity on it? Like, for example, I think last year when COVID hit, I think airlines were not investable. You could not invest in airlines because it was so opaque. You knew air travel would go down, then you don't know how much the government will help. So some businesses will get affected a lot. And other businesses actually will do better because of this. Like, Zoom has done much better because of COVID. And so I think that, John Templeton used to say that trouble is opportunity. So when you have these types of events going on, the baby will get thrown out of the bathwater. And so if you can identify certain businesses that you understand well and their prospects, near term, long term, are pretty good, then those might be worthwhile. And I think especially if they fit into parameters like mixed sleep, where they are high quality businesses at the core, then it's a good way to go.
So Mohnish is quick to say that no, you don't want to be stuck in the mindset of waiting for something to happen. You don't want to be caught in the mindset of, the lockdown was so severe and we're going to see the effects across the next year or two. I'm going to wait for something to happen and hope that I can pick up some bargains later. In Mohnish's opinion, that's really not the way to handle it. He is much more focused on analysing individual businesses within his circle of competence right now, and then seeing whether this event that we're just going through, the global lockdown, happens to present any opportunities to us right now, right here as we stand. He draws on the example there that not every business is affected the same by the events of today. For example, airlines got decimated, but social media and telecommunication companies thrived. That was his example with Jio, which is an Indian telecommunication company. So it's not about waiting for something to happen. It's simply about analyzing what is happening right now, looking at individual businesses, and as Mohnish says, trouble is opportunity. So if you can identify businesses that you understand well and their prospects in the near term and the long term are pretty good, then they might be worthwhile. So first takeaway, don't get caught waiting for something to happen. It's already happening. And while it is an uncertain time, the current events can actually work out very well for a lot of businesses. So there's always opportunities somewhere. Okay, but next up, what do you do when you're already invested in some great companies that you really like, but they are currently copping it due to the current conditions? What then?
I think if you say to me that the company has great capital allocation, okay,
Yes.
it has to have great. And the second thing you say to me is that their balance sheet can more than easily handle whatever hiccup year or 2 or 3 is producing. And you also say to me that at the core, it's a great business. I hate the hotel business. Okay, you go on, this Make My Trip or whatever, and you transparently see all the prices, and then you pick the lowest price. I mean, that's a useless business. Okay, your dumbest competitor is setting the price. But yeah, so if you can figure out that the core business is a great business run by great capital allocators, looking out for the shareholders, there could be some great bargains. But
Okay.
please be careful. Some businesses you should only be a customer of, not an owner.
So this makes total sense, right? If you're in a business and the company is getting hammered currently, but the management team is crushing it and investing well, and the balance sheet is healthy, aka they have ample cash and not a lot of debt, and their business model is fantastic, then there's not too much to worry about. You have to remember in that case, you own a business, not a stock. So stop watching the stock, just watch the business. In fact, probably you might want to watch the stock because, as Mohnish says, there could be some great bargains to be had. So really what Mohnish is saying here is just keep a cool head. Don't let your emotions get the better of you when you know that you hold a great business. Okay, next question that came in was asking a very relevant question for right now. Essentially, there are heaps of great companies out there. We're seeing a lot of great growers, many of which, unfortunately, right now are very expensive. But the question was, how do you filter through these companies to actually find the best ones?
And the answer is that you only need one of those in your lifetime. You have 50 years as an investor, and you only need to be right once on a business like that. So I'll give you an example. And I find this example even more compelling than Nick Sleep's example. So there's a company in South Africa which is now 106 years old. They were like a book and magazine newspaper publishing company. It's a company called Naspers. So in 2001, Naspers, 20 years ago, invested $32 million into this Chinese company called Tencent. Okay, so they put 32 million into Tencent, and they got a 43% stake in that business. And what is mind-blowing about Naspers and the chairman, I mean, the guy who was the CEO, who's now the chairman, is through the 20 years that they owned it, they never sold the stock. And what ended up happening is the $32 million investment. So Tencent has a market cap now of about 700 or 800 billion US dollars, and they sold a little bit, I think, in the first 4 or 5 years, but basically they held about 1/3 of Tencent. So the Tencent position that they own is like around $200 billion. Okay. So this $32 million investment became 200 billion, became 8,000 fold return for them. And they have done extremely well on their other investments and other things as well. This wasn't just one aberration, but everything else pales in comparison to Tencent. And throughout this 20-year period, they got tremendous pressure from every corner you can think of to sell off the Tencent position. So Tencent became $1 billion position, they were told to sell it. $10 billion position, they were told to sell it. $100 billion position. And to their credit, the two guys who were at the top pretty much told everyone to get lost. So the thing is that, you don't need to be right that many times. What you do need is extreme patience. And when you find something that is incredible, step up to the bat. Make it a meaningful bet.
There you go. You don't need to be right that many times. What you need is patience to find the right opportunity, and then when you do find that opportunity, swing hard. But actually, reading through the lines on this example, I think the biggest lesson Mohnish is trying to convey here is that we should be thinking much longer term. We need to really extend our time horizons. Yes, we need to be patient. Yes, we need to wait for that right opportunity. Yes, we need to grab it when it comes along. But importantly, don't be convinced to just let it go. Extend your time horizon. Just hold on to it. And this is something that Mohnish has been talking about much, much more recently. The most important thing to do right now is to look for the long-term compounders, the ones that you can actually see compounding for multiple decades into the future. Because here's the thing, even if you get your valuation wrong and pay too much right now, if you buy a long-term compounder, in most instances, it just won't matter. If you stuff up your valuation, you end up paying 3 times what the shares are worth now, but the company is growing at 20% annually, then in 10 years, the company will be 6 times as big. In 20 years, it's going to be 38 times as big as it is today. So that's something that Mohnish has said he's really learned from studying Nick Sleep, especially today in the strange times where everything seems expensive. Focus on the long-term compounders, because a lot of the time, even if you overpay for a long-term compounder, holding it for an extra long period of time will have you still coming out on top. And you think about this, in 2010, Apple was $6 to $12 per share, obviously adjusted for stock splits, but imagine your friend bought in at $6 and you decided to pass on it at 12 because you thought the price was too high. It had gone up 100% in a year. That's crazy. Way, way, way too pricey. Well, today, your friend is probably retired somewhere maybe here, while you're still working your boring 9-to-5 job somewhere around here. If you have the patience and the temperament to hold long-term compounders for a very long period of time, in Mohnish's eyes, that's the secret weapon in this current investing climate. This is definitely the main message that Mohnish is teaching right now, and he further supports that message with this example about Walmart.
Another insight Nick Sleep got was that he looked at this company, Walmart, and Walmart went public in 1970. Okay, so now Walmart has been public for 51 years. And the only people who have held the stock for the entire 51 years is the Walton family. So Sam Walton died. Sam Walton's children have started dying. And the grandchildren are still holding the stock. So the Walton family pretty much has not sold. It got split amongst many different Walton family people, but they have not sold the stock. They just get the dividend, but they have held the stock for more than 5 decades after going public. They held it even more if you look at the time it was founded. So Nick Sleep asked the question that if you owned Walmart stock as an institutional investor in 1980 or 1990, what caused you to sell the stock? Right? Why would you sell such a great compounder?
It's a good question. Why would you sell it if you're focused on the business and the business just keeps compounding and doesn't stop? Why not just keep holding on and think long term? If you did that with Walmart, you'd be very, very wealthy. If you did that with Apple, you'd be very, very wealthy. There are countless examples. So big, big, big takeaway there that Mohnish is talking about a lot at the moment. But what about if you're just not sure? You think you're onto a winner, you've got a long-term compounder, but there's still a few things on your mind that stop you from pulling the trigger. What then?
What my take on all this is that there's no need to have envy or scratch your head or even try to say, I need to figure out which one over here. Things need to be at the end, they need to be a no-brainer. So when you're making an investment, in the end, before you make the investment, it has to be a no-brainer.
So there you go. At the end of the day, it needs to be a no-brainer. And I think if people applied this thinking, they'd actually do much better at investing. Because most people make 8 or 10 or 12 investments a year, and then they're nervous about them because they're not 100% comfortable with maybe the price or the valuation that they bought them at. It's just better to just forget this approach. I like this test. Before you pull the trigger, ask, is it a no-brainer? If it isn't, don't buy it. I guarantee this will lead to fewer but better investments and also a lot less stress. So this is one I really like. And personally, from my point of view, I made 2 investments last March because back then when the stock market was crashing, I felt like they were no-brainers. But then more than a year went past without me buying anything because I couldn't get anything that even remotely felt like that. And now just recently, I've made one investment in the past couple of weeks because again, I feel like this one is a no-brainer. And these opportunities don't come along very often. It's worth remembering that you might get one a year or less. So just stay patient. As Buffett says, you wait for that ball that's thrown right in the slot, okay? And when that pitch comes along, you whack it as hard as you can. Not every pitch will be in that slot, but remember, we as investors, we can't be struck out. We can just let pitch after pitch pass through until 100 pitches later, that perfect one comes along and we can just absolutely smack it. So overall, guys, they are my main takeaways from this latest Mohnish Pabrai Q&A. Long-term compounders, extend your time horizons, be ultra patient, but when you know you can swing, swing hard. But remember to go along for the ride. And if the business is compounding, then forget what CNBS is saying about the stock. Just focus on that business. You're in a good business. You don't want to sell it. Forget about the stock. Focus on the business. Anyway, guys, that will do me for today. Thank you very much for watching the video. I hope you enjoyed it. I hope you got something out of it. Mohnish Pabrai is just such a good investor and a really good educator. That's why I love listening to all of his talks on his YouTube channel. So go and subscribe to his YouTube channel. Maybe if you wanted to have a listen through the whole Q&A, I'll leave that link down in the description if you wanted to check it out. But overall, guys, that is it. Leave a like on the video if you did enjoy it. Subscribe to the channel if you are new around here. If you've not subscribed, definitely do so. And if you're interested in how I go about my personal investing approach, passive or active investing, feel free to check out PROFITFUL, links in the description below. But that'll do me for today, guys. Thank you very much for watching, and I'll see you guys in the next video. Thanks again to Sharesight for sponsoring this video. So recently, I finally decided to stop being lazy and I imported all of my stock portfolios across into Sharesight. Finally. I should have done that a hell of a lot sooner. So with Sharesight, you sign up, you link your Sharesight account with your stockbroker, or you just add your positions manually. And then from there, Sharesight tracks everything for you. It tracks your capital gains, it tracks your dividends, it'll track your dividend reinvestment plans, it'll track gains and losses from currency fluctuations. Seriously, this is by far the most thorough portfolio tracker I have ever seen. And because they track and record everything so thoroughly, they can provide you with all of these reports. So from literally simple performance reports to complex predicted future cash flow reports if you're a dividend investor. But here's the really good thing, they also provide all of these detailed reports for tax time. So send these reports to your accountant, done. Plug these numbers into your tax return, done. Simple as that. It's a big, big help. And most of these features are available for free, but to be honest, to get the best experience, I would personally bite the bullet and upgrade to a paid plan. Honestly, this is one of the few stock market related subscriptions that I would actually recommend. It's very, very helpful, particularly when it comes to tax time. Anyway, if you did want to sign up, simply use the referral link in the description, or you can go to sharesight.com/newmoney, and Sharesight will give you a special offer of 4 months free when you sign up to an annual plan. So at least sign up for the free plan. It will make your life easier. But that's it for today, guys. Thanks very much to Sharesight for sponsoring this content, and I'll see you guys next time.